In a stunning turn of events, the Federal Reserve has abruptly reversed its policy stance, sending shockwaves through global financial markets in just the past 48 hours. Investors and analysts alike are scrambling to make sense of the sudden shift, as volatility surges and asset prices fluctuate wildly. What could be driving such a dramatic move, and who truly holds the reins in this high-stakes environment? Is this the beginning of a new era, or merely a temporary disruption? The uncertainty is palpable, leaving everyone to wonder, are we witnessing a calculated strategy or a reaction to deeper hidden pressures? Japan's decision to raise its government bond yield to 1.7% might seem unremarkable at first glance. Yet, beneath the surface, this move has sent shockwaves through global financial markets. Why would a single adjustment from Tokyo trigger such widespread concern? The answer lies in Japan's role as a major lender to the world, with trillions invested in foreign assets. When Japanese yields rise, capital tends to flow back home, draining liquidity from other markets. Suddenly, central banks like the Fed are forced to reconsider their strategies, fearing ripple effects that could destabilize the global financial system. Is it possible that a seemingly minor change could ignite a liquidity crisis on a worldwide scale? The yen carry trade is a financial strategy where investors borrow Japanese yen at low interest rates, then convert the yen into US dollars to purchase American assets. This approach takes advantage of the interest rate gap between Japan and the United States, allowing traders to profit from higher yields abroad. However, when yields on Japanese government bonds begin to rise, the equation changes dramatically. Suddenly, the cost of borrowing yen increases, making the carry trade less attractive. As a result, investors rush to unwind their positions, selling off U.S. assets and converting dollars back into yen. This reversal triggers a massive and unprecedented wave of capital migration, with funds flowing out of the U.S. and back to Japan. Could this be the start of a global financial reshuffling, and who stands to benefit or lose in this new landscape? In a surprising turn of events, investors from Japan, China, and several other countries have simultaneously started selling off U.S. Treasury bonds. This sudden wave of withdrawals has caused the traditional sources of demand for these bonds to vanish almost overnight. With the Federal Reserve unable to step in and fill the gap immediately, the U.S. market now faces a critical dilemma. Who will support the backbone of American finance if global confidence continues to waver? Is this just a temporary shock, or the beginning of a deeper crisis? The implications for both Wall Street and Main Street are profound, raising urgent questions about the future stability of the financial system. We are facing a classic lose-lose scenario for the Federal Reserve. If the Fed decides to keep interest rates unchanged, bond yields may surge, putting immense pressure on the U.S. national debt and tightening fiscal conditions. But what happens if the Fed cuts rates? Inflation could resurface, and the U.S. dollar might weaken, shaking global confidence. In this delicate balance, the Fed is forced to send signals of compromise, walking a tightrope between economic stability and financial risk. Is there truly a right move, or is every option fraught with consequences? Three unmistakable signals suggest the Federal Reserve is on the verge of a policy shift. First, unexpectedly dovish statements from key Fed officials have caught the market's attention. Second, Fed funds futures are now pricing in aggressive rate cuts, reflecting changing expectations among major financial players. Third, the reverse repo facility has dropped to record lows, indicating a significant shift in liquidity dynamics. These developments are not isolated. Together, they paint a picture of a central bank preparing to change course. Is this the turning point investors have been waiting for, or just another false alarm? Market psychology is revealing a striking shift. Investors are not betting on the Federal Reserve cutting interest rates out of optimism for economic recovery. Instead, their focus is on the growing risks within the liquidity system, signaling calculated panic rather than hopeful expectation. Why are seasoned players so concerned about liquidity, and what does this mean for the broader financial landscape? This is not a typical rally driven by positive sentiment, but a defensive maneuver in response to underlying instability. The question remains, is this a rational reaction to danger, or are investors amplifying fear in anticipation of systemic shocks? Reverse repo balances have plunged below $400 billion, a level not seen in recent years. What does this mean for the financial system? This sharp decline signals that banks are facing a shortage of liquidity, while major money market funds are pulling their capital out. The Federal Reserve, once protected by a comfortable liquidity buffer, now finds itself exposed. As the repo market flashes warning signs of rising credit risk, investors are left to wonder, is this the start of a deeper crisis, or just a temporary shakeup? The stakes are high, and the next moves from key financial players could determine the direction of the entire market. The Federal Reserve finds itself trapped in a dilemma with no easy way out. If interest rates remain unchanged, yields continue to climb, putting immense pressure on the U.S. budget and threatening the stability of smaller banks. But if the Fed decides to cut rates, the dollar could tumble, triggering surges in gold and cryptocurrencies and potentially reigniting inflation. Is there truly a winning move here, or is every option fraught with risk? The global financial system seems to be teetering on a knife's edge, where a single decision could unleash unpredictable consequences. In this high-stakes environment, who will bear the brunt of the fallout? And can policymakers find a path that avoids disaster? What if the Federal Reserve is no longer in control of the global interest rate race? Imagine a scenario where it's not the Fed setting the pace, but Japan pulling the strings. This shift means the Fed is forced to react to international capital flows, rather than leading the market as it once did. Could the world's most powerful central bank really be chasing after decisions made in Tokyo? If so, what does this mean for the stability of global markets? The balance of power in finance is more fragile than ever, raising urgent questions about who truly holds the reins in today's economic landscape. In the past, whenever the Federal Reserve cut interest rates, liquidity would swiftly return to the markets, and public debt levels remained manageable. This mechanism provided a sense of security, as policymakers could rely on monetary easing to stabilize the economy. But is that still true today? As we look toward 2025, the landscape has changed dramatically. The United States now faces a record-high national debt, and the Fed's policy tools are far more limited. Can the same old solutions work when the scale of the problem has grown so much? Or are we entering uncharted territory where past strategies no longer guarantee stability? The Federal Reserve faces mounting pressure to cut interest rates, not to stimulate economic growth as in previous cycles, but to prevent the U.S. government from plunging into a debt crisis. This marks an unprecedented reversal of roles in modern financial history. Traditionally, rate cuts have been a tool to boost the economy during downturns. Now, the central bank's actions are being driven by the urgent need to manage soaring government debt and avoid fiscal instability. What does this shift mean for the credibility of monetary policy? Are we witnessing a turning point where financial markets must adapt to a new reality? The implications could be far-reaching, challenging long-held assumptions about the Fed's priorities and the resilience of the U.S. financial system. As we move forward, a surprising revelation emerges. Japan, not the United States, may be the true force constricting global liquidity. The unwinding of carry trades, where investors borrow in yen to invest elsewhere, could trigger a shockwave, making the Federal Reserve vulnerable and reactive rather than proactive. Is it possible that the Fed, often seen as the world's financial anchor, is now at the mercy of market dynamics beyond its control? With time running out, can the Fed afford to delay decisive action? The stakes have never been higher, and the next moves will shape the fate of global markets. For over 2 decades, the yen carry trade has been a silent force powering global liquidity. Investors borrowed yen at ultra-low interest rates, then poured these funds into higher-yielding assets abroad, fueling markets from Wall Street to emerging economies. But now, for the first time in more than 20 years, this engine is reversing. As the carry trade unwinds, capital is rushing back to Japan with unprecedented speed. triggering a cascade of sell-offs across U.S. markets. Why is this happening, and what does it mean for the stability of global finance? The sudden withdrawal acts like a flash flood, exposing vulnerabilities and amplifying volatility. Could this be the tipping point that reshapes the balance of power in international markets? Japan holds the title of being the largest creditor to the United States, a position that carries immense influence over global financial markets. When Japan decides to sell off large amounts of U.S. Treasury bonds, it sends shockwaves through the system. No other nation has the capacity to step in and absorb such a volume, leaving a critical gap in demand. As a result, U.S. bond yields surge, defying even the Federal Reserve's attempts to stabilize the market. What does this mean for the future of American debt? Can the system withstand such a dramatic shift in ownership? The answers remain uncertain, but the implications are too significant to ignore. For the first time in 2 decades, U.S. Treasury bonds are losing their shine. Japanese government bonds are on the rise, and the U.S. dollar is showing signs of weakness. Faced with a ballooning deficit, the U.S. is forced to sell more treasuries, but the Federal Reserve is reluctant to step in with quantitative easing, fearing a surge in inflation. What was once considered the world's safest asset is now viewed with caution as risk replaces stability. Is this a temporary shift, or are we witnessing a fundamental change in global finance? The implications ripple through markets, leaving investors to question where true safety lies. Market sentiment has been shattered. When Japan begins to sell, global investors fear being left holding U.S. bonds that could quickly lose value. This herd mentality triggers a widespread wave of sell-offs, as no one wants to be the last to exit. The panic spreads rapidly, amplifying volatility and uncertainty across financial markets. In this environment, even the Federal Reserve finds itself on the defensive, reacting to events rather than steering them. Is this the start of a new era of instability, or just a temporary shock? The answer remains uncertain, but the ripple effects are already being felt worldwide. What happens when the Federal Reserve is no longer in control of interest rates? International capital flows are now dictating yields, leaving the Fed in a reactive position rather than leading the market. If the Fed insists on keeping rates high, the cost of servicing U.S. government debt could skyrocket, creating a dangerous feedback loop. Could this push the American economy to the brink of disaster? Are we witnessing the end of an era where the Fed sets the tone? Or is this just a temporary shift in global financial power? The stakes have never been higher, and every decision carries immense risk. A chain reaction is unfolding. Japanese government bonds surge, triggering a massive unwind of carry trades. As investors rush to adjust their positions, the U.S. dollar faces heavy selling pressure, leading to a sell-off in U.S. treasuries. Credit spreads widen, signaling rising risk in the financial system. Systemic risk escalates, forcing the Federal Reserve to consider cutting interest rates sooner than expected. But what happens next? Inflation could make a swift comeback, challenging the stability of global markets. Are we witnessing a complete upheaval of global liquidity as we know it? Japan hasn't openly declared any intention to pressure the Federal Reserve, yet its recent moves have sent shockwaves through global markets. By intervening to support the yen, Japan is acting in its own best interest, preventing further currency depreciation, attracting capital back home, and keeping imported inflation in check. But what does this mean for the rest of the world? Could a single nation's defensive strategy trigger a chain reaction across financial systems? Investors everywhere are now watching closely, questioning whether Japan's actions mark the start of a new currency war or simply a rational response to domestic challenges. In this high-stakes environment, every decision carries global consequences. Despite the market's sharp declines and waves of uncertainty, many individual investors continue to buy the dip, holding on to optimism even as volatility surges. What drives this resilience? For some, it's the belief in long-term value, the idea that every crisis is an opportunity to accumulate assets at a discount. Others are guided by a mindset of steady accumulation, convinced that patience will eventually be rewarded. But is this faith in the future justified, or are they simply ignoring warning signs that professionals heed? In the end, the question remains, who will be proven right in the long run, the steadfast individual investor or the cautious institutional player? At this critical juncture, two opposing scenarios loom over the financial markets. If the Federal Reserve maintains high interest rates, the risk of systemic breakdown intensifies, threatening stability across sectors. Yet, if the Fed chooses to cut rates, inflation could surge and financial instability may return with force. It's a delicate balance where even a subtle shift in policy language can trigger massive market swings. Investors and institutions alike are left guessing which path will the Fed take and what consequences will follow. The stakes are global, and the outcome hinges on decisions that could reshape the financial landscape overnight. At this moment, every investor faces a crucial choice. Are you truly investing, or are you simply gambling with your capital? The difference lies not just in intention, but in discipline and strategy. Do you have a clear plan, or are you following the crowd's emotions? Setting strict limits for losses and gains, maintaining unwavering discipline, and sticking to your strategy, these are the hallmarks of a real investor. In contrast, chasing quick profits without a plan often leads to reckless speculation. So, where do you stand? Are you building wealth with calculated decisions, or risking it all on chance? Looking back at the market's dramatic swings, we see two distinct camps emerge. The major financial players act swiftly, often prioritizing risk management and strategic exits, while individual investors cling to long-term optimism, sometimes bordering on stubborn faith. Some approach the market with a disciplined investment mindset. Others are driven by the thrill of speculation, riding waves of fear and hope. In moments of panic, logic can give way to emotion, testing everyone's resolve. So, where do you stand? Among the cautious strategists or the bold risk-takers? Ultimately, navigating these turbulent waters demands clarity, discipline, and self-control. Only those who remain vigilant and measured can withstand the storm and make decisions that truly serve their goal.